what was typical in the 1980s in Latin America was 1,000%, 2,000% inflation. So how can you import capital in a country with 1,000% inflation rate? You can't do it. So you had to get rid of the inflation rate. So to get rid of the inflation rate, you had to get rid of the government spending. To get rid of the government spending, well, first of all, you had to bring the fiscal balance back into balance. But you didn't want to do it with high tax rates. So you wanted to have a government surplus and low tax rates. So the only way you can do that is take government spending from some very high number to some very low number, which meant a lot of people starved during this period of time when you're trying to turn the economy around. So the government has to get out of the business. And by the way, I will refer to this again next discussion, because the United States is that kind of fiscal deficit where the same thing is being projected by an awful lot of investors that's going to happen here. And this is basically their model by which they've created these expectations. So in any event, what they had to do is get rid of the inflation. They had to get rid of the barriers. And if they get rid of the trade barriers, now getting rid of the capital barriers was easy because they're the ones who erected the barriers, not the United States. We never had capital outflow barriers. The only countries of the world at that time that were financial centers were the countries without capital barriers. I mean, it was the United States, the UK, Germany, Switzerland, and Hong Kong. And that was about it. Every other country had barriers. You couldn't get out. So, and the ones that didn't have barriers, where money went in and out, became the financial centers where wealth gravitated. So basically, they had to get rid of it was very easy for them to do it, and it was totally unnoticed in the United States because it's nothing we did. The part that we did do was agree to with NAFTA. And basically, I think we have to thank the Vice President Gore for winning the debate with Ross Perot, if you remember that episode. We had a national debate as to whether we should, pass NAFTA. And Al Gore won the debate, and Congress passed it. And beyond that, we also got into WTO, World Trade Organization, where if you join WTO and you're accepted as a member, then the contingency is you lower your tariffs. And that's how we got China involved and got rid of the tariffs against communists. Is they just simply joined the WTO, and we just had to ratify their joining the WTO. So basically, Carlos Salinas came up with the idea of how to take a country with a lot of excess labor, very low wage rates, get rid of the barriers to capital flows, get rid of the barriers to trade flows, put in other special inducements like foreign exchange reserves and some guarantees to foreign capital that they won't lose value relative if they're in the peso. So you had to have foreign exchange reserves for this. And there were a few other things, but if you think about it, what you had to do in 1990 is you're a representative of the Mexican government. You had to go up to New York and talk to some investment bankers and say, hey, I'd like to interest you guys in an investment in a Mexican company. Well, when they got through laughing, and they pulled themselves off the floor, you had to go through the program of exactly what you're going to do. I mean, basically, like you effectively had to walk into Fidelity and say, look, you have all these mutual funds, like you have a mutual fund called Technology. Well, we have a technology company in Mexico. You should be investing part of that portfolio in Mexico. And again, it required a major education on the portfolio managers, on the potential and the fact that you've gotten rid of your past. So the money trickled in slowly in 1990. 1991, 1992, 1993 were huge booms. The capital flowed into the emerging nation, into countries we now call emerging nations, started to call emerging nations. All the countries of Latin America followed Mexico within a year or two. And then it spread to Southeast Asia within a year or two. And on top of that, the former communist countries where communism goes away in 1990, they also get into becoming capitalists as well, and they were also educated by Carlos Salinas on how to do it. So Eastern Europe gets into it, Southeast Asia gets into it, and the biggest one of all, China, gets into it. So suddenly there was a watershed event. The watershed event, obviously, is the less developed poor countries learned how to become producers, and they were so equipped to become producers and sell their products to the developed world because they could do it at a small fraction of the cost of producing in the United States, and as a result, U.S. manufacturing has gone away, And I guess in the last few weeks we've seen like our icon of U.S. manufacturing finally literally go away. So they won. And as I said last time, they had very high levels of income. Their savings rate was extraordinary. It was about 30% was their savings rate. And then, and China, it's 50%. The consumer saves 50% of his income. And they're directing 80% of their savings into the U.S. market. So now we have this new paradigm. And what is variable E? Now, here these guys were in Washington thinking we got this all under control and we could do it on Constitution Avenue and 20th Street in Washington at the Federal Reserve by small changes in the discount rate. And suddenly, this foreign capital comes surging in from the emerging markets. And the Fed is no longer in control of the money market rates in the United States. Number 4. This shows it perfectly clearly. This is a period of time during the Great Moderation. We're out of the tech bust. Look at this, June 04. This is, we were in the tech bust. Tech bust, what goes 2000, 2001, 2002. We start coming out in 2003. The Fed now starts to say, okay, the economy is reviving. And the economy is reviving, and we have the risk that we're going to overshoot into the inflation period. So very slowly and gently, let's start raising the cost of money and regulating the system and keep it under control in the Great Moderation. And this is the discount rate set by the Fed. And the discount rate from a low of, actually started a little lower. This shows 2.25. I think it was even lower. So in 04, and in these every 6 weeks or so, they raise it 1/4 point, and here it is by 06. It's up to almost 6%. But then you take a look at the 10-year Treasury yield. Now this discount rate is arbitrarily set by the Fed. That's the rate at which they lend to their banks, and the banks usually take the money that's loaned to them and then add something onto it and lend it to their clients. So here the Fed, we're coming out of this recession. They want to get an early start on preventing inflation, and they're trying to pull in the reins and raise the cost of money. And this is their policy variable, and you can see they're trying to raise rates. And guess what happens? The market rates on the Treasury start to decline. The 10-year starts to decline. The Fed, by the way, doesn't intervene in the 10-year market. Greenspan said, well, we're coming out of the recession. We're starting to raise the discount rate. So some astute congressman says, well, Mr. Chairman, if you're trying to raise rates, how come the Treasury yield keeps going down? And Greenspan kind of flashed red. Not in anger, but embarrassment. He said, I don't know. It's a conundrum. I.e., that's the anomaly, right? Just like Thomas Kuhn said, if something happens that's inconsistent with the system, you don't throw out the system, you just call it an anomaly, put it on the side, and try to figure it out later. So what we have in here is actually Greenspan's statement on the conundrum. And actually, the source is below, and it's a website, and you can read the whole testimony. I took a few paragraphs of it and put it on following page 4. It's called the Greenspan Conundrum. Greenspan said a number of explanations have been advanced for what he called this remarkable worldwide environment of low long-term interest rates, but examined the various explanations. Greenspan said none of them seem satisfactory. Then he goes and asks his staff. Some economists were saying, well, this money is probably coming in from the emerging markets, and what they're doing is buying treasuries, pushing the price up and the market yield down to the tune of $300 billion a year. How much was the Fed buying a year at this point? Maybe 20 or 30. Okay, so you tell me who was making monetary policy. So he says, I don't know why this is happening. It's a conundrum. And he ends up, what's the last paragraph? The economic and financial world is changing in ways that we still do not fully comprehend. So that's what happens when you're a paradigm cop, and he was the ultimate paradigm cop, and he's not going to admit to the fact. Frankly, I pulled his book out to read to see if, after he retired, whether he confessed to whether knowing it or not. I don't know if he ever has, or whether this is just simply denial, as Thomas Kuhn said that the paradigm cop will do. I don't know if he really knew it or not. But he asked the Fed staff in the second paragraph, And he said, some noted economists advanced the idea large accumulation holding of U.S. Treasury foreign governments such as China had doubtlessly helped to lower the rate of long-term treasuries. But he said a Fed study estimated the impact was modest. Well, that's the last people you ask, because who is more bought into the paradigm and is a paradigm cop at the Fed staff? So you get to, so you're caught. We're caught. Basically, what we have is an institution in Washington of government and an institution on Wall Street that have bought into the old paradigm, and the paradigm has changed, and they're still in a state of denial. So basically, where are we now? What is the new paradigm? Foreign capital comes in, and the foreign tsunami is foreign capital. And the level of foreign capital exceeds the Fed's buying capability, and they basically now control the market. All the capital's coming from abroad in quantities that swamp our savings flows and in quantities that save our central bank's ability to try to keep control of the interest rates. The conundrum, Dave, is exactly right. In 2005, it was laid bare. They still don't admit to it. Now, in a way, they've kind of admitted to it because the Fed has sized up for the battle. Now, here's our problem. Foreign capital is now in control of world interest rates, not the Fed. Once you open up all these economies and capital can flow across borders, the Fed buying is a much smaller proportion of the total pool than when we had closed capital markets. When we had closed capital markets, the Fed could control it. But now that we've opened capital markets, the Fed is a small-time player compared to the larger mass of world capital. So now what we have is a situation where we have this new paradigm, still not totally fully recognized, because what they're really doing is fighting fires of keeping firms from going bankrupt and banks from going bankrupt. It should be very interesting in the future of how it's going to evolve to try to keep within the confines of no recession and not more than 5% growth when we no longer control the money market rates. Now, I don't know the answer, very frankly. I mean, I can just throw out some ideas. For one, there's going to be probably greater, quote, central bank coordination across the world in the future. But that's easier said than done because these people have different political agendas. And they all have their own problems at home, and they want to solve the problems at home. But the point is, if any country of the world, like China or Brazil or Argentina, wants to have expansionary monetary policy to get rid of unemployment there, if you have free capital markets, the hedge funds just go borrow from those companies and then buy U.S. securities and then get the rate low, and then U.S. Investors, who are building factories or are building real estate projects can borrow the money cheaply from abroad. They don't need to access U.S. banks and the Federal Reserve System. So now we have a really unknown out there, namely what is going to be the moderating technique to keep us in this within the bounds, or looking at it in this diagram is to keep growing at potential. Either way, what is going to be the mechanism to control the economy in the future? Now the Fed has, beefed up their balance sheet from $800 billion to $2 trillion. But that was really not an effort just to beef up the balance sheet so we have more purchasing power relative to the world capital markets. It's still tiny. That really was a beefing up just to save the banks, to put out a fire that we had here. So I'm not sure what the overall end of this is going to be. Instead of really worrying about how the Fed is going to expand further, which if the Fed expands further, it sets off inflation expectations and the market starts to price stuff down. So the Fed expands and it has a perverse effect on markets. I'm more concerned about another story. We've been living on foreign capital. What happens if that foreign capital decides they had enough of this fun buying U.S. mortgages and buying stuff that was supposedly AAA and wasn't AAA and supposedly guaranteed that wasn't guaranteed?